Australian Wealth Builders, helping time-poor executives build financial independence through property investing.
Hi, Cam McLellan here. I'm here with good friend and business partner, Matt Lewison. Matt, how are you?
Thanks, Cam. Good to see you again.
Yeah, likewise. Now you've just moved up to Brisbane. You've been one of the people who have decided to sell up and move to the sunny side with after all COVID lockdowns and those sort of things. So how's life in Brisbane?
Life's good. You're making me sound like a COVID refugee, but it's just been a long time planned, this move to Brisbane.
It was, I know.
Albeit that there's been a lot of other people moving up from Melbourne and Sydney. It's definitely made things interesting.
Yeah, that's very good. Now, we've got a good topic today, Matt. We want to talk, obviously, there's different grants in different capital cities, and the majority of the grants are all about stimulating the housing industry, and the grants are fairly focused on new builds. Obviously, the government wants to generate new building construction to stimulate the economy. So I want to talk to a few things about new builds, how to not overcapitalise, and specifically how to design your investment to cater for the future and future trends. And also if I've got, for example, an investment property in an area and lots of new builds are coming onto the market in that area or being built around, how do I compete with those, or how does those new builds impact my existing investment? Do you reckon we can wrap that up into a nice little podcast for people today?
I think we can. Well, let's start with that last bit. Why do you think, Cam, that a new home is going to compete with an existing home?
Yeah, that's a good point. I don't myself, but I posed the question because it is something we had feedback on in one of our webinars. There was some people were concerned that if they had an investment property, which maybe was a couple of years old, and there were new builds coming on the area, that they'd be seen as inferior, or the new builds coming onto the market may have an advantage over their existing property. Do you want to unpack that in what happens out in the marketplace?
So there's two parts, isn't it? There's competing for tenants, maybe. Obviously, if the new builds are investment properties as well that are going to add to the rental pool. And then there's, I guess, a perception maybe you'll compete on price. But if we go back to like our first principles of an investor, of what our goal is in growing our wealth, we want to maximize our valuation over time.
Correct.
So every time a new build is completed, it's not until that new build actually sells, that creates a new capital benchmark for a suburb. So what we tend to find is that suburbs over time evolve, and every year, I guess, the quality of housing improves. I moved, and just a quick example, I moved into and bought in a suburb called Ashburton about 10 years ago, and my dad asked me, why would I buy in that suburb? It was full of post-war workers' cottages and social housing. But what I saw in that suburb was that there was a lot of new housing coming in, and the new housing was lifting the bar and creating that new capital benchmark. And obviously people were investing substantially in that. So it's actually something we love to see, is people investing in new housing and people renovating as well. So they're really positive for you as a property owner if you're in a suburb with an established house. But I guess then the question comes to, what about on the rental side of things? Are you competing with them? And how does your valuation also stack up against those new builds? And I guess that's one of the keys for us. So we obviously have to we do a lot of research, not looking at what's happening in the market now, but what we think is going to happen in the market in a few years' time. And again, another, I guess, real world example, and we learn from our own, I guess, past mistakes as investors, and that's what we're able to help new investors with today. But over a decade ago, I built an investment property in a growth area suburb, and I was worried about the capital benchmark in that suburb. So I built a 4-bedroom house. Actually had a 450 square metre block, but I built a 4-bedroom house with only one living area with no external al fresco, because I was really worried about overcapitalising on that house. Now, in hindsight, the extra living area might have cost me 15 grand and the al fresco might have cost me an extra 5 or 10. 10 years later, when I was looking at valuations in that suburb, I saw that houses with 2 living areas and an al fresco that were otherwise comparable with mine were selling for $70,000, $80,000 more than what I was getting as a valuation. I guess that's something that we obviously cottoned on to a lot sooner as a result of, I guess, our experience, to realise that you don't plan for today's valuation, you plan for your valuation in 4 or 5 years' time. Identify some trends that are happening and make sure that you're providing, I guess, a house or a building that's going to maximise your potential for upside in the future.
Yeah, I think the old saying is, which if people can get their head around this, your net wealth is determined by the bank panel's valuation on your future portfolio. So you're always looking to maximize your future portfolio. That being said, people can make a lot of money if they design new builds correctly. And this is a lesson that I learned. I'd done, and this is probably before you and I started investing and developing together. Your older brother Al and I had been developing for a fair while under the guidance of your old man Steve. I think you were living up in Brisbane back in these days as well. But I'd done a lot of dual locks and triocks at that stage myself. I was probably 25 years of age and had done maybe half a dozen different developments. And that stage, and I met Felicity. I must have been 24 because I'd met Felicity. She was 19, and I talked her into buying an investment property. So we went home, told my now father-in-law that she was buying an investment property. He was pretty angry because we'd actually signed the contract at that stage without consulting him. And then we had to tell him that it wasn't just an investment property. It was a 4-unit development site that we'd purchased, or Felicity had purchased as her first investment as a 19-year-old. That investment or that development probably gave me one of the most valuable lessons, and a lesson that we carry through today for all OpenCorp clients as well. And it gets down to the fact that having the optimum size and quality property can save you a huge amount. And people talk a lot about the term overcapitalizing. But overcapitalizing really comes down to design. Getting your design right is the best way not to overcapitalize or to maximize your value. So up to that stage of development, I tried to jam 1 or 2 units on the backyard of somewhere. So when I'd go to the draftsman, I'd make the development really efficient and I'd design it really quite tight. When we bought the place that Felicity purchased with 2,600 square metres, we went to the same drafty. Drafties are proud. They build big boxes. The 4 units he put in the existing house, and the really existing house, he actually designed about 4 square metres larger than the previous ones we'd done. Now, that was about, at those times, about $40,000 more to build those, but I wasn't going to get any more in sales price. So what we realised, the overall development was going to cost about 160 grand more, but we weren't going to maximise anything. Now, we didn't realise that until I'd gone through and got plans and permits and gone through the pain of going through council and planning, advertising, all those sort of things, and then got the finalised build price. So we ended up selling that for about 200 grand profit, that development, just with plans and permits, and handball it off to someone else. So it wasn't a basket case, was one of the biggest learnings and probably what I'd still deem as a mistake. We made a couple $100 grand on when the original property was, probably bought it for 370, sold it for 512, I think it was, so thereabouts. But that was a really good lesson. Now, if we take that to people building new now, and what we talk within our office when people are designing the optimum size and quality property, we see often that the team's there, and it's usually the design team. Girls are out there with the tape measures and designing out each room and laying them out and putting furniture in the spots and trying to get the most efficient size, because to get the optimum size and quality, you're battling against everyone. So draftsmen want bigger, builders want bigger because they make more, agents want bigger because they can rent it or sell it more. Everyone wants bigger except the investor. Investors rent bedrooms. A bank panel valuer is not going to value something dramatically higher just because it's slightly larger. They're going to look at it and go, it's that size block, 4 bedrooms, 2 living, 2 bathroom, bam, there's your price. So, in a very crude manner. So I think if I go down to optimum size and quality, if you can trim off a 20 metre long house, trim 500 mil off the side of the house by making the rooms a little bit more efficient, you've saved yourself 10 grand. Now that's 10 grand that can go towards the next, deposit. So that's a very rough way of explaining how not to overcapitalise on size.
Yeah, I think we need to just make sure everyone also is aware it's a careful art, or it's a bit of an artwork, because
I've described it very crudely there. Yeah.
If you just keep trimming, you get to a point where you are impairing your rents, but also you're impairing your valuations. And so we have a valuer in our team, obviously, to make sure that we are thinking like valuers, not just thinking like investors as well. And I guess the insights that we can provide there is that valuers also work off a square metre rate for a house or for the building. So it's not just that they look at the 4 bedrooms, 2 living areas, al fresco.
Oh, no, very true.
What it's worth. But and again, it's probably an error in terms of how valuers think, because buyers don't think like this. But valuers do think bigger houses should value more. However, there's a threshold for every type of dwelling. So it's called, we use the term stratification of different product types within the market. So previously people would just look at the median house price. So what's the median house price for a suburb of Greenvale, for instance? And if you're below that, you're doing well. But now valuers are a lot more savvy in some regards. And the data that's available is a lot more, I guess, detailed. So now we can actually break down the median for different product types. What's the median for 4-bed, 2-bath, 2-car, 2 living areas plus al fresco? What's the median for 4-bed with only 1 living area? What's the median for 3-bed? What's the median if they're double stories? And different lot sizes as well. So there's actually a bit of science that goes into it. And as Cam said, you want to be really careful because you're getting your rent for the bedrooms, and there's very little movement that we see depending on, I guess, the inclusions of the house, although there are some really key things in a specification that we've found over time boost your rent and get you a premium over the market or help you to rent faster. But that, I guess, requires deep knowledge. But as a general theme, the bedrooms are what generate the rent. And then obviously the valuation is a much greater science that needs to go into it to make sure that you're not just going to get a good valuation on the day you buy it, but that over the next 10 years, your valuations are going to improve and you'll see that equity going up, hopefully faster than the market price in that suburb, because you've got a smart design that picks up all these things that are going to add value over time.
We've crossed over and talked valuations in both how new builds add value to existing homes in the area. And I think it's a really good point that people need to understand. If you're trying to maximise your valuation to increase your net wealth, then you shouldn't be fearful of new builds coming into the area because they're going to value up higher, hopefully, than your existing property. And once that benchmark has been set by the valuers, they look back at that, and when they come to value yours actually gets pulled up with it. That's basically in summary for people who are probably concerned about new builds coming to the area.
Yeah, spot on. And something else we used to talk about as a land developer was you sell your best land, and this might be a bit of a step and I'll get to my point. But developers want to sell their best land as early as possible. So if they're building lakes or they're building shopping centres, they want to deliver that stuff early. Deliver that and sell it. The goal of it is that they end up selling their worst land for more than their best land. And to make some sense of that, ties into this topic. If they sell their best land first, people come and build nice big houses. They create a new capital benchmark and they create an environment where people want to live. So the better quality of housing there is in a suburb or in an estate, the more people want to live there and the more they take pride in their house. Over time, developers tend to, in large master plan estates, make smaller and smaller lots. So they sell off their best land as early as they can. If they can deliver it early, then they just keep shrinking the lots over time. But they make, I guess, the housing quality improves over time as well. So it creates, I guess, a feedback cycle. The better quality housing, even though it's on smaller lots, which is coming later in the project, it's pushing up the value of the inferior housing that was built earlier that was on slightly larger lots, or which maybe was a little bit more generous in terms of what was provided, or it was better located. So there's a whole heap of interacting things here, but generally the theme is that new housing adds value to the stock of existing housing because it's often of a higher quality, and that's the key. If it's new housing that's of inferior quality, that's going to drag down, I guess, the desirability of a suburb and drag down valuations for you in future. So you want to make sure you're getting into a suburb that's going to be attracting investment from owner-occupiers and investors, if need be, that's going to be adding value to the quality of stock.
Yeah. And then in the rough and ready way that I explained, not overcapitalising when it comes to size, obviously there's a point where the valuers look at the square metre rate, like you mentioned, but there's a point where the local market sales just realistically won't support a sales price in comparison to the build size as you keep increasing it. So there's that maximum benchmark that you should not build over because you're not going to get any more in sales revenue and valuation or rental. But we've talked about, obviously, that size. Talk us through optimising some of the fixtures and fittings. What should people be looking for, or how do they compare or ensure they don't overcapitalise on fixtures and fittings?
Yeah, it's and obviously these things go hand in hand, don't they? Because it's be like, I guess, putting a Rolls Royce and then taking it down to like the cheap used car yard and trying to sell it like in the country town when it's all decked out with all the bling. You probably don't have a big market for that. So as much as people might want it, then the same with housing. If you build a big mansion in a suburb where people don't have the budget to buy it, or you just go absolutely overboard with fixtures and fittings, like whether it's tapware and you can, I've just renovated a couple of bathrooms in Glen Iris and geez, tapware can really burn you and cost a fortune. And a lot of people don't see it, but certain suburbs like Glen Iris, feedback from agents was you'll get back what you invest plus more if you create the right vibe in your house. But again, if I go to a growth suburb, let's say it was out in Werribee, if I was putting that tapware and fixtures and fittings, I've probably spent more on the bathrooms than most people would be able to afford in.
Yeah, no, but that's what I mean. But your end sales price, this thing's going to auction very shallow. So bet part of $100,000 on something that you're hoping to get upwards of $3 million for becomes. But if you try and spend close to $100,000 on a bathroom in an outer suburb, well, that's half the cost of the whole house. You know what I mean? So yeah,
absolutely. And people won't see that value. They're not going to go, well, I'll pay an extra $95,000, $100,000 for this house because it's got 2 great bathrooms. They might pay $5,000 more for it because that's kind of the limit of their budget. And you're thinking about competition in future. And if you convert it to rents, we might not get any extra rent, or it might be $5 a week extra. So every decision about fixtures and fittings is balanced around, is this adding to my rent? Is it adding to my resale value by positioning this property as comparable to a set of houses I'm expecting to be getting sold in the years to come that I want valuers to, I guess, consider comparable to mine. And that's, I guess, a process you have to go through. And then probably the flip side of it is you're also thinking about maintenance. If it's a property that you're holding, it's not just the rent that you get, it's also your holding costs factor the net income to your property. So you want to make sure that you're providing fixtures and fittings that are good enough quality, they're not going to break. But even like curtains, you could go in and put block-out blinds and nice sheer curtains in, and somebody comes along and the kids pull it off the rail and you've just had to spend another $1,000 replacing those. So you have to be careful about that balance. And then probably the last part that I will add to that is there are certain things that are very easy to add to a property if you ever look to sell it. So when you've held a property for investment, and again, there was another one of mine I sold about 1.5 years ago when I was repositioning my portfolio. And that was a property that I'd underinvested in landscaping because I just wanted it to be really low maintenance. But I knew if I dressed it up at the back end before I sold it, it would make the sale really easy. So obviously spending 10, 15 grand on landscaping at the end can add $30,000, $40,000 of value if you do it right. Doesn't mean you spend it at the front end where you're not going to get any extra rent for having a nicely landscaped garden. And in fact, it can create more problems for you in terms of costs to maintain that. Or obviously the tenant, a lot of tenants might see that as a maintenance problem for them in the future. So it's a decision-making balance between low cost to hold, increasing your rent, and positioning your property to get the best valuations in future. And as I said, getting ready to sell it, if you ever decide to exit the property, that's not difficult. That's a month, like 4 to 6 weeks of just doing the window dressing and making sure that it's going to present the best for the highest resale value. But you don't need to plan for that right at the front end where you're chucking money in that you're just going to probably have to do it again at the back end when things are old and dated.
Yeah, no, very good. I think we've nailed it off pretty nicely. Is there anything else as far as people should be aware of when it comes to ensuring their new build is up to the standard of a local area? How do they go about making those comparables? Because I know the areas that you and your acquisition team and build and development team work within, you know exactly what quality and size works in each area, but someone coming new and trying to assess an area, how do they go about making sure they build the right size, build the right quality?
Yeah, we've obviously got a lot of tools at our disposal that cost money for us to have all the time. So I can't, unfortunately, just suggest to people you go and jump on to these databases and you can go through all the information and pull up sales data and categorize it and export it to filter. But if you're doing it on your own without an expert who's holding your hand and sort of doing that in the background for you, then speak to a lot of agents, look at the sold data. There are recent sales that you can now pull off realestate.com, so you can look at those sales. Unfortunately, in some markets, they don't publish prices, which makes it really, really tough if you're doing it at that kind of front end. And the other side of it is talking to real estate agents. Their view of what's optimum and ours as an investor is very different. They're thinking about what's going to make my job absolutely like a no-brainer for me to get a sale. And of course, they're going to say the bigger it is, the higher the spec is, the easier it is to sell. So you have to be really specific about your questions. It's not asking them what size should I build and what should I put in it. It's talking about, I guess, specific examples of what has sold and why did one thing sell over another, and how much they think a property with X, Y, or Z would be in this area, so that you're actually you're feeding them the information. You just want them to give you guidance in terms of, I guess, the premium they think you would get for different inclusions or design elements.
Yeah, and if someone's not using your team to optimize the size and quality, being aware that the builder's floor plans are definitely optimized to make them the most money. So take into consideration the cost square meter rate to build dry areas compared to wet areas, and ensuring that if you're increasing or decreasing size, you're making a clear differential between the cost for a bathroom as opposed to a media room.
Yeah, geez, you've opened up a whole new can of worms. So, and again, it's for something that we know. Obviously, my dad was a builder, and what I realised early on is that you don't pay for air in a house. You pay for how many battens there are. You pay for bits of plastic. Theoretically, that's what it costs the builder to build. But the way they charge is often you increase the size of the house, regardless of what room it is, the price goes up substantially, even if they didn't need any more materials to do it. Correct. In fact, I've been through processes with builders where you cut out the hips and valleys, so you make the roof line a lot more efficient, which reduces their costs, and they try to charge you more for it. And if we weren't, I guess, savvy to what they were doing, then you could see how people end up spending more money on build, when the reality is we've made it more efficient at times, which allows us to have a bigger footprint for the house in the right rooms where we're going to get value for it.
Yeah, well, the classic one is when someone wants to increase a media room or a living area, and the builder just divides the entire square meter rate and adds that on. So, and they're picking up some nice margin there at the consumer's expense. Anyway, I think we've nailed off a few topics. Hopefully we've given people clarity on a few things as far as new builds adding value to existing for the area, not to be fearful of new builds. That's really what we want for an area, is to drag our existing valuations up. And a few things to be very wary of when it comes to building new, not to overcapitalise and build the optimum size and quality for any area. Hope it saves people a few dollars. Louis, thank you very much for your time. Enjoy the sunshine, mate. I'm going to go and take my kids to basketball training.
Always good, mate. Take care.
Cheers, buddy. Bye.
The information featured in this podcast is general in nature and may not be relevant to your personal situation. You should seek advice from a licensed professional before making any investment, insurance, tax, property, or financial planning decision. Guests appearing on this podcast may have a commercial relationship with the companies mentioned, and opinions and views expressed may not reflect those of the Smart Property Investment Network.